first day of trading after a week-long holiday. Our next guest thinks retail investors should completely avoid China. CNBC contributor John Rutledge is chief investment strategist at Safana. John, always great to see you. You think this whole thing was a head fake? You don't believe the stimulus will have any effect?
No. Li Jiang is trying to hit their 5% growth target. They're not going to make it. They have terrible real estate problems. Pay offers are going down. Home prices last month fell 5%, biggest number since 2015. They have to find a way to stop that real estate deflation. And without that, all they can do is small moves from the central bank, half a point on the interest rates and a tiny move in the reserve requirement. And they're throwing half a trillion RMB, which is like $30 billion at the problem. It's just not enough. And an investor, to me, is someone who's hanging in for the free cash flow stream, not for the moment. And so that free cash flow stream requires you to own something for more than a year. More than a year means you're only going to get the dividend in the next year. The rest of it, your hopes and prayers. I think that as long as Xi Jinping is running the place, he'll keep teasing investors with bring your money, and then he'll do something to drive them away again. And they're doing that right now.
What do you think is the hardest part about the real estate market to fix, and the thing that maybe is the most misunderstood by Western investors? I mean, I'm wondering because, you think about, for instance, the ghost cities in China, and a lot of those apartments were paid for in all cash by average people who are looking to invest. They're empty. Yeah. They're still empty. There's no infrastructure around these apartment complexes. But what can be done to make people feel like that investment has paid off or is gaining in value? I mean, it's just an asset that's sitting out there that can't be liquidated.
It's a great question, Melissa. Their wallets are empty, too, their bank accounts. And so there's nobody out there to buy them. In the announcements they made week before last, the central bank announced they were going to do something to allow first-time home buyers to have a lower down payment, 15%. They were doing something to allow local governments to help people buy houses, first-time home buyers. But those are tiny things in a market that's vastly overbuilt. And those apartments are not going to go away. So when you build an economy based on purely real estate inflation, it takes a long time to unwind it. And during that time, I don't want to own Chinese stocks, partly because of that, but mostly because Xi Jinping can wake up in a bad attitude one morning and take it all away from you by picking up the phone. That's not a place I want money.
So, John, with that backdrop, what are the likelihood of something bad happening with the Philippines, which has been in the news recently, and or Taiwan, which has clearly been in the news for the last 3 years?
Well, Guy, Taiwan's the big question. Nobody knows the answer. But Xi Jinping wants to get that done while he's still alive, and he's an old guy, so he doesn't have too long to make it work out. There's discomfort inside the party among the older members of the party for that. And the military is not really very tightly organized at the moment. We can see that from the people that they've pulled out of key positions. So they're not in a spot where they can do that. The Philippines, they can make a lot of trouble there and all over the South China Sea. And there's not much we can do about it because we're stretched between Ukraine and Israel. And we're not paying much attention to what China's doing out there.
John, what we saw today also is sort of China's response to increasing tariffs being put on their products around the world. We saw them put retaliatory tariffs on brandy, for instance, out of Europe in response to Europe's taxation of EVs. How far along does this go, and how do you see this playing out next year after the elections? Because either administration looks to have sort of a very tough view on China.
Absolutely. The Economist has put out estimates of the amount of tariffs you'd get from these two candidates, and they're both really big. Trump's are even bigger, and they put a real dent in trade. To that extent, they put a little bit of upward pressure on prices here, but they also reduce growth there. And so I think that tariffs are going to be in the news big between now and November 5th. But after that, they're going to recede a little bit because the political payoff for rattling the cage on the tariffs is much lower after that. But trade with China is going to be tough, and the tech trade especially, because the more we worry about national security, the less we're willing to sell them these fancy chips that you folks were talking about.
Jared Woodard is here. He's head of the Research Investment Committee and ETF strategy at Bank of America Securities. Jared, welcome. You want to go up against Tepper like that?
Hey, Kelly, it's good to be with you. Look, I think there's always opportunities in the market, and our view today is that whether it's monetary easing in the United States or easier policy in China, these can be incredibly powerful in the very short term, but probably aren't the number one place to commit capital today for anyone who's looking for big returns on a 6 or 12-month time frame or longer.
I was sort of took note, and I'm sure you did as well, that Stanley Druckenmiller remains, I don't know if you'd say bearish, but not excited about the possibilities in Chinese stocks. He said until there's a leadership change with Xi Jinping, and I'm sure many people share that view.
I think it's also about the broader economy in China. This stimulus package is, of course, a positive, but our economists in China, our strategists at Bank of America, and other colleagues, investors we speak to all have the same view, which is that the fundamental economic challenges faced by the Chinese economy are not resolved by these stimulus measures. If you don't have a robust consumer base, and you're exporting, with the most growth toward other emerging markets, that's not been the kind of recipe for incredible dynamism for Chinese equities. And I think that's worth noting. It was not that long ago, just last month, that Chinese government bonds hit an all-time low, record 2.0% yield. The government was, I think policymakers were pretty stressed out about this. You could interpret some of this stimulus, I think, as an effort to divert flows of capital away from the bond market, from deflation toward the stock market. And we don't have the view that this is the kind of fiscal bazooka, as it were, that would give you multi-month, multi-quarter sustained economic growth, beyond the trend level.
So are you in it anywhere for a trade, or are you really on the sidelines here?
Well, I appreciate the comments from Dominic earlier. When you have markets that are closed or illiquid, or where you don't have the kind of transparency in data, accounting data, earnings data, et cetera, that investors in the United States might be used to, I think it makes those trades even riskier than they already are. There's a lot of ways to benefit if you see sustained economic growth in China, or even earnings from their companies in terms of orders around the world. I think that those second-order derivative investments, whether it is in Australia or Latin America or commodities, might be a better way to play any upside that does happen without requiring the kind of challenges that sometimes happen when investors overseas try to get active in mainland Chinese equities.
Yeah, no, that makes a lot of sense. You're looking elsewhere as well for, kind of areas of the markets that have actually outpaced the triple Qs this year, you think still have upside, and they range everything from national defense stocks to U.S. industrial renewal plays, nuclear power kind of fitting in with that, and then you're still bullish on Japan.
That's right. I mean, everyone has artificial intelligence on the brain, but I think it might be interesting news that all of those trades you just mentioned, those have been big bullish positions of ours for a while, have actually outperformed the growth stocks this year. Most portfolios are weighted something like 70% toward growth equities, but we see better opportunities elsewhere. In Japan, for example, you've had massive corporate reform. When I was speaking at our Japan conference last month, it was interesting how many investors think that we're still only in the third or fourth inning of those big reforms. You're seeing record buybacks, record capex among Japanese companies, and on our estimate, there's something like 33% of GDP still locked up in cash on corporate balance sheets in Japan. As those reforms work through, I think you can expect much more structural upside in those equities, much more productivity and earnings potential in that market.
Yeah, we showed the other ways you like to play these. But again, Japan was kind of preceded China in many of the measures that China's now taking to try to boost its stock market as well. So with perhaps a little bit brighter story to tell in the long run. Jared, we'll leave it there for now. Thanks for joining us today.
Thanks, Kelly.
Jared Woodard.
And those Chinese ADRs got absolutely smoked. Or was there something else going on?
Yeah, I do think so. So I think there are two things here. Chinese ADRs, I mean, that was a disappointment, the fact that Chinese ADRs fell. But in some ways, it was expected. When stock prices went up dramatically after the stimulus, our team was never in the camp that this was going to continue. And the biggest reason is because there are structural problems that these stimuli actually don't really solve. And I think today was a testament to the shortcomings of these stimuli. Not only was the announcement but falling short of expectations, but the stimuli actually don't really guarantee that the Chinese economic trajectory is going to change, because we have a balance sheet recession type of slow growth with a lot of debt in the books. And then, of course, there's the geopolitical problem. We have learned in recent years that China has become, again, an export-oriented country. It's relying on other countries to buy their goods in order for them to grow. But as we know, there are a lot of tariffs that are being instituted. We're talking about it here in the United States. We've heard about it in the European Union. So as long as these tensions exist, the ability for the Chinese economy to grow organically, there's going to be a lid on that. So I don't think anything is really going to satisfy the markets. And if it does, it's going to be temporary, and you have to keep feeding that beast.
So would an announcement of 2 up to 10 trillion RMB from the Ministry of Finance in the coming days or weeks change the narrative for you then?
Well, so the question is, how long does that last? Right? I mean, is it going to be a year's funding or 2 years funding? One of the things I noticed was there's a little bit of a pulling forward of borrowing, right? So that already tells you that they're way behind. And the language there is, okay, we want to hit 5% target, but we also want to stabilize the economy. Stabilizing the economy tells me that it's unstable, right? So how do you go from an economy that feels like it's shrinking, it's unstable, to 5% growth? There wasn't that much detail there. So even if there's this idea that there's stimulus coming in, the question is, where will they go, what will they fund, and how will they be allocated? And none of those details were provided today.
Yeah, none of those details have been provided today. Anna, do you think that's primarily because policymakers don't want to set a benchmark in terms of the kind of euphoria they've already seen to there being no number signaling their support or the quantum of the support they're willing to provide to the economy? And already we've seen this crazy frenzy, so they don't want to stoke that even further.
It's possible, yes. I mean, it's definitely possible. You know, a lot of the frenzy is partly because, you know, all of those rate cuts that we have seen in the last, you know, several years, it was always not enough, not enough, not enough. And it might have actually also caught them by surprise when the markets reacted that way. So it definitely could have been a way for them to just tame it a little bit, because frankly, there was a sell-off, but it didn't go back down to, you know, the dismal levels, right? So maybe it's a way of stabilizing it, but at the end of the day, so some of the structural problems in the Chinese economy remain. And so now the markets will be watching very closely what type of stimuli come next.